Hi everyone, my name is Sam DeCourt and welcome to our August monthly video update. Joining us today, PiFund's Chief Investment Officer Mike Taylor and Kent Williams, Head of Global Equities, joining us from Sydney. Hi Kent, hi Mike.
Hi Sam.
Hey, Sam.
Now, before we get started, this is actually going to be our last of these monthly video updates. We actually started doing these back in March of 2020 when COVID hit, and we thought, what can we do? We need to communicate lots and lots. So we're doing them weekly back then, I think, weren't we, Mike?
Yeah, I mean, it's 6.5 years ago. It's quite a long time ago now. I do remember those. It was a very stressful time. And as you said, that was really important to over-communicate at that time to our investors.
And I think we must be approaching probably 100 or so of these videos over the last 6.5 years. But the view is that we will consolidate this content into our monthly newsletter, Slice of Pie. So there'll still be monthly videos. Anyway, thanks for joining us for the last video. We'll get right into it. Mike, what's been happening in markets over the past month?
As usual, plenty going on in markets. If we can ignore the political commentary, tariffs on neighboring countries, wars in the Middle East, which, still do have an impact on markets, but it's probably not the main thing that I'm focusing on. What I am focusing on is interest rates creeping higher around the world, and the Treasury Secretary in the US trying to kind of what we would term jawbone interest rates lower. So making selective commentary and talking about the US Treasury buying longer dated bonds to bring those yields down. That was effective for about 48 hours before yields started to creep higher. And the important kind of move as a result of that was an increase in commodity prices, namely things like copper and gold. Gold in particular has seen a very strong bounce through the month of August, having previously come off its highs through kind of the period possibly from about May until late June, mid-July. This is called the debasement trade. So the US is effectively, well, the market is viewing it as that they are debasing their currency against other assets. Of course, gold is a big beneficiary of that, but we even see things like Bitcoin have rallied significantly during the month. So that's probably the main story of the month.
On the topic of gold, obviously that links in quite closely with our Australasian funds. And it's been nice to see after a really challenging 10 or 12 months with Australasia that 2/3 or so through August, at the time of recording this, we've actually seen our Australasian funds jump between sort of 5 or 6 and 10 or 11% so far in August, which is probably the biggest divergence we've seen between Australasian performance and global for almost a year. How much of that is driven by gold and how much of that is other stuff?
Well, investors will recall that actually last month, in my note, I mentioned that Australia was looking quite good value at the moment. So I'm pleased to say that has come off in terms of a nice strong rally for the month. Look, a lot of it has been driven by resources. If you think about the emerging companies fund, a large portion of the index is related to resources, and it's already a stellar month. Some of the gold names are probably up 40 or 50% through the month of August. So that's a big move. Yes, we have exposure to commodities through all of the Australasian funds. And so, look, they've all done well. But it's not just gold. I mean, there have been some companies that have reported really good results, which we own. And, some of those, particularly software names, were oversold. And they've rallied, significantly through the month. So it's not all gold, as I said. And we're probably 3/4 of the way through Australian reporting season so far. There's about a week to go, and I think it's treated us reasonably well to date.
Thank you, Mike. Okay, over to you now, Kent. And I would assume that since you took over the Global Growth and Global Growth 2 funds around 18 months ago, you've probably been on these videos probably every 3 or so months. So we talked about them quite a lot. Really good to see performances remaining strong and your two funds up sort of 20 and 22%, I think, over the past 12 months.
That's right.
And this is in a market where increasingly, where we track other global active managers, there's been some huge examples of underperformance with funds being 10, 20, even 30% behind benchmark over the past year. Your fund's been right up there, there or thereabouts, slightly ahead of benchmark. How have you positioned them to capture all the upside?
Sure. Lots to unpack, so I'll try and do that as quickly as possible. But really, since taking over, there's been two trades. The gold trade, which as Mike just mentioned, and then more importantly is the broad AI hardware trade or semiconductor trade. So that's been the second one. The AI hardware trade has really, this last 12 months, driven the lion's share of returns in the market. So if you think, the numbers that Sam put out, that the funds and the market has gone up about 20%, at least half of that is coming from that AI hardware thematic, and that doesn't necessarily even include the industrial companies that are part of the build out, the contractors and things like that. So very comfortably, half of the total market return contribution has come from the AI hardware trade. And obviously that's not half of the market. AI hardware sort of sector is probably about 15 to 20% of the market. So it's really driven it from the returns. And I think that's really where we've kind of done quite well, because it's one thing I keep talking about with that process is it's very much market aware. So we want to be aware of what is happening in the market to make sure that if a trend or a thematic like this does happen, we're not caught offside. And I think unfortunately for a lot of managers, that this actually happened. It feels like, looking back, it feels like it happened quite slowly over a 12-month process, but living it and breathing it, these moves, there's been really explosive moves, stocks up 1,200%, 2,000% in 12 months. So it's been really quite explosive. So if you don't have that sort of awareness of the market and agility to kind of move, I think that's caught a lot of people offside quite a bit.
And just to clarify, Kent, when you say there've really only been two trades, you're not saying they're the only two trades you've done. You're saying these are the key themes that you haven't wanted to miss out on, right?
Yeah, good clarification. Trade versus theme, yeah, absolutely. They're the two major themes that have driven returns in global equities, absolutely.
So obviously riding the momentum up is one thing, but also avoiding the huge drawdowns is another key thing. And one of the conversations, Kent, you and I had last week was drilling down to semiconductor holdings. So can you maybe elaborate a little bit on how you've positioned Global Growth 2 to be overweight semiconductor stocks, yet in July, when semiconductor stocks dropped sort of around 20% or so, the fund actually generated outperformance. How was that possible?
Sure. Yeah, okay. Good question. So as I mentioned, as Sam mentioned, semiconductors and that broad AI hardware thematic is one of our biggest overweight positions in the fund. So when that sells off, the question is, how do you actually outperform the market? And the reality is it all comes down to the way we design our funds, our signals, and then what we do with portfolio construction. So to really simplify it, effectively, when you think about semiconductors, there's a whole raft of different businesses across that value chain. And when you have a market that is moving, as I said, stocks up 1,200, 2,000, 2,000%, there's a lot of spread in terms of the level of risk in the market. So what we've done, the way we design our portfolios is, we want to capture that thematic that we've spoken about, but we want to do it in a manner that is reasonable and sensible. So we purposely avoid the highest risk stocks. We avoid the companies which are not profitable. We avoid the companies which are really expensive. What we're looking for is companies which blend all of those metrics, because we know we can overweight this thematic, and that's going to deliver the more consistent returns throughout the cycle.
Thank you, Kent. Good explanation. Thank you, Mike. More importantly, thank you to the audience who've watched and listened and read the written version of these updates. We've really enjoyed doing them, and I'll be back in some form doing probably ad hoc videos from time to time when there are major events. And other thing to watch out for is we have our annual road shows around the country in November. So invites will be following in the next couple of months. Thank you all very much.
Yeah, just reiterate what you said there, Sam. Thanks everyone for tuning in to this over the last 5 or 6 years. Really appreciate it. Thank you.
Thanks, everyone.